Hello and welcome to the show. I am Puneet Wadhwa, and today we have with us Mark Mobius, founder, Mobius Capital Partners. Hello, Mark, and welcome.
Hi.
So, what's your interpretation of the recent geopolitical situation and its impact on the global financial markets? Is the worst behind us, or are we in for more pain ahead?
No, I think what we're probably going to be looking at is a long, drawn-out situation, war in Ukraine, and it doesn't look like Putin will give up easily. And of course, the Ukrainians are not going to give up easily. And more importantly, the Europeans and the international community generally are in support of the Ukrainians, and they're going to try their best to support the Ukrainians, which makes things much more difficult for the Russians, of course. So I think we're looking at a drawn-out situation, which makes Europe somewhat dangerous, let's put it that way, and makes other countries around the world much more attractive.
So if the European markets shiver, which all markets across the globe do you think will catch hold?
Well, I think the other markets outside of Europe will do well because they will be safe havens. So the US equity market, the Brazilian market, South Africa, China, Taiwan, all these countries that are not involved in this European situation will do quite well, I think.
What about the US and Indian markets?
The Indian market, of course, will do well because they are somewhat isolated from that situation as well. And the US market should do well as well. The only hiccup and the problem facing markets around the world, of course, is the fear of higher interest rates. But this is a very temporary fear because as we look at history, you'll see that interest rates actually don't really have that much impact on the stock markets. They have a big impact on the fixed income market, of course, but not the equity markets.
Indian markets, Mark, they are grappling with the problems of their own. On one hand, they are looking at the US Fed hiking rates. We are looking at higher crude oil prices that can stoke inflation fears. Then we have the impending state election outcome sometime next week. So all this doesn't it make Indian markets a little more wobbly over the next few weeks or few months?
Well, yeah, in the short term, you'll get some wobbliness, you might say. But in the long term, the Indian market should do very well because you've got very productive companies, very profitable companies. You've got a government that is intent on modernizing the economy, making it more computer friendly. So all of the technology that's being brought to bear is going to have an incredible positive impact on India going forward.
So for an Indian investor, will market diversification be a good idea right now or a bad idea? Should they be concentrating on the local equity markets?
It's very, very important for everyone, whoever they are, whether you're sitting in the US, India, China, South Africa, Brazil, wherever you are, you have to be diversified away from your own market. So, for example, for the Indian investors, you've got to be having, of course, a good part in India, but you've got to be in other parts of the world, countries in Asia, countries in Latin America, and of course the US market. So diversification is very important. And we've learned that, as you can see with the situation in Europe. You know, if you were sitting in Europe with lots of stocks in Germany, you're not in very good shape.
So what's the most crowded trade according to you right now? Is it equities, is it bonds, is it real estate, is it gold, is it commodities?
Well, I always believe that people should have gold, physical gold. But the big winner is always equities. The reason why is that equities adjust to inflation. They adjust their prices in line with inflation. So they're always ahead of the game. So companies that are profitable, that are able to raise prices in line with inflation should do very, very well going forward.
What's your view on how central banks will respond to the recent developments? Do you see them printing more money, going easy on the rate hikes over the next few months?
I think central banks realized they made a big mistake in lowering rates to such a low level. And now they're trying to catch up. In the US, as you know, the inflation numbers show 7.5%. And of course, interest rates are way, way below that. So they're going to try and catch up. Of course, the complications of the Ukraine war may cause them to slow down their rate hikes, but generally speaking, they're now in a catch-up mode, and you can see rates going higher.
So if the US central bank slows the rate hike process, do you think that equity markets could probably bounce back from the current levels?
Yes, they will, because as I mentioned, if you look at the historical relationship between interest rates and stock market, there really is no relationship. High interest rates do not necessarily kill the stock market, the equity market. So there's no reason why we can't see the market bouncing back.
What are your views on the Indian markets per se, Mark? What kind of returns can one expect over the next 1 year or so?
Well, this year is going to be a mixed picture. You're probably not going to see the incredible returns that we saw last year, but I think they'll be reasonably good, maybe 5-6% like that. But it's anyone's guess, depending on what the macro situation develops globally. But I think you're going to get returns, but not as good as last year.
So within the equity universe in India, do you think that the mid and small cap companies could probably outperform this year, or will they be underperformers?
Well, I always believe that the unnoticed medium and small caps tend to do better than the large caps, because the large caps are very well researched. Everybody knows about them. So they're sort of priced to perfection, let's put it that way. Whereas the small and medium cap stocks are not very well researched, and there are opportunities there. You have to, of course, pick and choose. You just can't, say that all medium and small caps are good, but you can get a lot of good opportunities in that space.
So rising oil prices are another worry for the Indian markets, which they can have an impact on inflation. How do you see corporate earnings play out in this backdrop over the next few quarters? Are we looking at a phase wherein we could see probably corporate earnings expectations come down?
Yes, of course, you're going to see that. You must remember, we're coming from a year, last year, where the earnings picture was very, very bright. Now it's mixed, and some companies are coming off this euphoria. So you're probably going to see the more moderate numbers. But again, it depends on the company. Some companies are going to do very, very well, and of course others will not. So it's an individual company.
So at the aggregate level, can you put a number to it?
Well, the economy is going to be growing at 6-7%. So you can expect a range of between 5 and 10% for most of the companies.
What has been your strategy over the past few months? Have you been looking to increase exposure in India or in any other markets across the globe?
No, we have not been moving in any direction, either selling or buying. If prices come off, we do have cash reserves that we can use to buy more stocks, particularly in India, but in other parts of the world.
So which stocks and sectors in the Indian context, probably would you look to invest in?
Well, as you know, we're big on technology. We like software companies, but we also like medical field, medical testing. And some of the industrial companies are doing quite well. India needs a lot of infrastructure, lots of home building taking place. So companies in that space are doing well as well.
Foreign investors, Mark, have been selling Indian equities since October 2021. Do you see this trend reversing anytime soon? And what is the key indicator that they'll be looking for over the next few months to start pumping money here again?
I think the key indicator will be actions taking place in the currency markets. We have to look at the Indian rupee to see where it's behaving against the US dollar and other currencies. If the current rate continues at these levels without any big change, then we can be pretty much assured that we're back to normal and we're going to see good earnings numbers coming in.
Primary markets have seen a lot of activity in the past 1 year. And probably they're now gearing up for their Aramco moment, so to say, in the initial public offer of the Life Insurance Corporation. Do you think that there's enough appetite amongst investors, foreign and retail, that can absorb this kind of a paper at this time?
Well, most of the large investors around the world are index investors. They're not buying individual stocks, they're buying indexes, and they're buying ETFs, exchange traded funds. So once the life insurance company enters the index, these people will be forced to buy the company, because in order to be in line with the index, they must buy this large cap stock that's entering the index. So in that sense, yes, the large institution will be buying.
So at a time when the foreigners were selling, retail investors proved to be a backbone and held the markets at reasonably good levels. So what's your advice to them right now? Should they go all in, or will the markets give them better opportunities to invest over the next few months?
I think in this environment, it's a good idea to have maybe 10, 15% in cash, waiting for the opportunities, because we may see more downside. Nobody knows whether the market's going to jump up or go down. And if you see a market coming down to more attractive levels, then you can use that cash to go in. So it's always good to have this kind of opportunity awaiting for you.
So one last question, Mark. What's your view on gold and oil?
Well, gold, as you know, I've been saying for a long time, everyone must have some gold in their portfolio, particularly physical gold, for emergencies. Just like now, people sitting in Ukraine who had gold are in pretty good shape. They can have a currency and they can get out with gold. And that's true of people in Russia. I'm sure the people in Russia who are holding rubles are very sad now because they've seen the ruble crash against the US dollar. So gold is always good as a safety measure. But then after gold, as I mentioned, equities are the place to be. Global equities, diversified portfolio.
I was talking about the price levels as well, Mark. Do you see them, 10% higher, 15% higher from here on, as well as what's your view on crude oil in this backdrop?
Crude oil will probably continue at this level. As you know, it's already gone up quite a lot. And I don't think you're going to see much appreciation. I know a lot of people feel that with Russia out of the picture, oil prices will go through the roof. I don't think so, because you've got a number of alternative energy sources, as you know, and also you've got the U.S. potentially becoming in as another player and boosting production. So I don't think this is going to be a real problem.
Thanks a lot, Mark, for your time today. We hope to see you soon.
Thank you. Bye-bye.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.